What's up guys? Today I will be showing you 3 ways how you can invest in the Philippine stock market. So again, if you like the content of this video, smash the like button and subscribe to my channel. Haven't you ever asked yourself, how can I make more money? I'm so tired of working. Is there a way that I can make money even while I am sleeping? Well, what if I told you there is a way? No, this is not a scam. I can assure you it's not. A lot of rich individuals have been doing this for years, and even the top billionaires of the world are tapping in this amazing money-making machine. So why investing in the first place? Is this that money-making machine that I talked about? Of course it is. Investing is where you can let your money work for you, and as time goes by, you are letting compounding interest grow and grow your money. As said by Albert Einstein himself, compounding interest is the eighth wonder of the world. Investing is one of the things you can do to let this wonder work magic for you. But it's so sad that most Filipinos use this wonder in the opposite direction. How is that? Loans after loans after loans. Some are even paying debt up to their retirement. So our goal is to use it the other way around. Let compounding interest work for you. But I just want to warn the viewers, being rich by compounding interest is not something you can get overnight. It's not like winning the lottery. You have to allow it to grow over the years. So how can I tap on this power through investing? I'll show you 3 ways. First is through a mutual fund. This is one of the most common investment vehicle in the Philippines. Mutual funds are pooled money of investors which is actively managed by a fund manager in which invest in securities or stocks. These managers are experts and they are the one assigned on what stocks to invest in hopes it may be able to beat the returns of the market index. Think about it this way. You just give them your money and they will invest the money for you. You don't need to look for companies individually. The manager does it all for you. That easy. But of course, this comes with a price. In the Philippines, most mutual fund here cost around 1.5 to 2% management fee annually. So if you have 10,000 invested in them, the management fee is 200 pesos at 2% fee. So it's a little bit high. But if you're lucky and the manager is really a good investor and keeps on beating the market index, well, that's how you get your money's worth. So the pros of a mutual fund is, first is diversification. It is one of the best benefits because these funds consist of multiple stocks, sometimes even more than the index which is 30 companies. Second, ease of investing. Because the fund manager does the job for you in picking stocks to invest in. So what are the cons of a mutual fund? First of all, high management fee. And second, lack of control on where you want to invest in. That's if you want to invest in certain companies. Examples of mutual funds here are Phil Equity Alpha 1 Fund, First Metro Save and Learn Equity Fund, Sun Life Prosperity Philippine Equity Fund. Second way is index fund investing. Index funds are almost the same as mutual funds, but it is not actively managed. It is a passively managed fund that tracks the market index, so in our country, the PSEI, Philippine Stock Exchange Index. This index is composed of 30 large companies. These are what you call the blue chip stocks. The primary difference of index funds from mutual funds is the index fund doesn't need a manager to actively handpick stocks to buy. This just tracks or copies a market index. The goal of index funds is to just match the market performance, unlike mutual funds that try to beat it. But you know what? Most mutual funds fail to do so. The best thing about index funds is its management fee is lower compared to mutual funds. Imagine, they don't beat the index but still they charge a lot more compared when you're just investing in an index fund. So for me, this is a much better choice for those who wants to invest in the market but doesn't have the time to study individual stocks. It was even advised by Warren Buffett himself. a low-cost index fund is the most sensible equity investment for the great majority of investors. By periodically investing in an index fund, the know-nothing investor can actually outperform most investment professionals, as said by the GOAT of investing himself. So the pros of an index funds are, it's almost the same as a mutual fund. First, diversification. Second, ease of investing, but lower management fees. Cons, lack of control. Second, won't be able to get better returns compared to the market. Because like I said, the index fund tracks the market index itself. It doesn't try to beat it. Still, market returns averages 8 to 10%. Now, there are a couple of ways you can invest in an index fund. One is also through a mutual fund. Now, don't be confused. There are mutual funds that only tracks an index. Its management fee is lower, although it sits around 1% compared to their actively managed fund that costs 2%. Second is through an ETF, or exchange traded fund. Now, the advantage of an ETF is you can buy it directly in your brokerage account. So if you don't want to go through a mutual fund, you just create your own brokerage account and buy this ETF. You can easily buy and sell it at a click of a button. Unlike through a mutual fund, it takes a little bit of time to buy and sell your investment. And that's not all. ETF's management fee is lower. There's only one ETF in our country as of this moment, and that is FMETF, First Metro Philippine Equity Exchange Traded Fund. Its management fee costs 0.5% annually. This is actually the disadvantage in our country. Unlike in other countries like the USA, there are a lot of ETF that are cheaper in terms of management fee. I hope in the future our country would innovate more on this side because index fund investing is a great way to invest. Lastly, individual stock picking. Now this is the hardest way to invest. But this is also the most satisfying and fun way because you get to pick what stocks, companies you want to invest in. If you have a favorite store and if they have a publicly traded stock and they have a good financials, you can support them by investing directly to them. It's like voting. You can choose whom you want to support. And what's more, you can also enjoy getting dividends. Dividends increase your passive income. Unlike most mutual funds and index in our country, that doesn't give cash dividends. Now, there are a lot of ways to approach the market. You can be a dividend investor, growth investor, value investor, or a combination of all. The sky is the limit for you, and if you have a talent for investing, you can beat the market by a landslide. Most index gain 10% annually, but if you're good, you can earn 15%, 20%, 30% or more. There are guys out there that get those number. But again, you have to research on your own. If you are just speculating, then the risk is higher for you. So this way, you can also underperform the market index. Now the pros of individual stock picking. First, complete control. You have complete control on where to invest in. Second, potential to have higher returns. Now the cons are, first, to be diversified, you need larger sums of money to be able to buy different companies. Second, more work, since you are the one researching for each company to invest in. Third, higher risk, especially if you don't know what you're doing and just invest based on speculation. So that's it for this video. By the way, the funds I showed as an example are just for the sake of giving you an example. So please, still, even if you want to invest in mutual funds or index funds, do research about it first. I hope this helps you out in tapping in the power of compounding interest. If you have any comment or suggestions for me, don't be shy to comment down below. So see you again in my next videos.